Imagine two completely different phone calls. In the first call, your bank rings to let you know that a mystery error just dropped an unexpected $1,000 straight into your checking account. Free money, no strings attached. You get a quick rush of dopamine, smile to yourself, and think, hey, nice. I might treat myself to a decent dinner tonight. Now imagine the second call. Your bank calls, but this time they inform you that due to a processing glitch, $1,000 was mistakenly wiped out of your account, and it's completely non-refundable. Be honest with yourself. Which of those two scenarios triggered a stronger physical reaction? If you're human, the second scenario didn't just annoy you, it made your stomach drop, your heart rate spiked, your palms got clammy, and a surge of primal anxiety flooded your bloodstream. Mathematically, $1,000 is $1,000. Gain or loss, the numerical value is identical. But psychologically, losing $1,000 hurts roughly twice as much as gaining $1,000 feels good. Welcome back to Money Mindshift. Today, we are cracking open the dark side of behavioral economics, the psychological glitch that forces millions of retail investors to make the absolute worst financial decision possible, selling at the very bottom of a market correction. When your portfolio turns into a sea of deep red, you aren't just looking at stock tickers. Your brain is undergoing a biological hijack. The exact same evolutionary software designed to save your ancestors from being mauled by a saber-toothed tiger is actively sabotaging your wealth in the modern financial markets. By the end of this video, you won't just understand why your brain panics when you lose money in stocks, you'll get the exact psychological toolkit to override your biological programming, master market volatility, and turn stock crashes into systematic opportunities. Let's break down the hidden glitch inside your head. To understand why stock losses feel like physical pain, we have to travel back to 1979. Two legendary psychologists, Daniel Kahneman and Amos Tversky, published a groundbreaking research paper that completely shattered traditional economics. Up until that point, standard economic theory assumed humans were completely rational mathematical machines. Traditional models claimed that an investor evaluates a $10,000 loss and a $10,000 gain with equal objective logic. Kahneman and Tversky proved that theory completely dead wrong. They called their discovery prospect theory. Look closely at this graph. The horizontal axis represents financial outcomes, and the vertical axis represents psychological emotional impact. Notice how the loss side plummets off a cliff? This asymmetric curve proves that the human mind does not register financial value in absolute numbers. Instead, we register changes in wealth through emotional extremes. And because our survival instincts were forged in environments where losing a meal meant death, our brains treat financial loss as a direct threat to our physical survival. When your portfolio drops by 30% during a market crash, your prefrontal cortex, the logical part of your brain responsible for long-term planning, gets completely sidelined. In its place, your amygdala takes total control. Your brain registers the falling stock price as a tiger in the bushes. It floods your body with cortisol and adrenaline. It screams one single command: run, escape, cut the pain now. And in the stock market, escaping the pain means clicking that big red button to sell your shares. This biological overload leads directly to one of the most toxic behavioral traps in retail investing, the disposition effect. Discovered by researchers Hirsch Sheffrin and Meir Statman in 1985, the disposition effect describes the documented tendency of investors to sell winning stocks too early to lock in small gains, while holding on to losing stocks far too long in the desperate hope that they'll break even. Think about how irrational this is. When a stock goes up, you get anxious that the paper gain will evaporate, so you sell immediately for a tiny profit to get a quick dopamine hit. But when a stock plummets, your loss aversion kicks in. As long as you don't click sell, your brain considers it a paper loss, not a real loss. Selling means admitting you were wrong. It turns paper pain into permanent pain, so you hold on to a failing asset, watching it bleed out month after month, trapped in the sunk cost fallacy, until you reach the breakpoint. Let's look at a concrete real-world case study. In March 2020, as the global pandemic sent shockwaves through the economy, the S&P 500 suffered the fastest 30% drop in stock market history, collapsing in just 22 trading days. Retail brokerage accounts exploded with panic activity. Headlines screamed apocalypse. Portfolio dashboards were flashing crimson red every single morning, and the pain became intolerable. On March 23, 2020, retail panic selling reached a fever pitch. Hundreds of thousands of individual investors couldn't take the psychological torture anymore. Their amygdalas completely hijacked their decision-making. They surrendered and dumped their portfolios straight into cash to stop the bleeding. What happened next? March 23, 2020 was the exact absolute bottom of the market crash. Those who panicked didn't just lock in lifetime losses. They sat on the sidelines in cash as the market staged the most spectacular, record-breaking recovery in modern history. They paid the ultimate penalty for human psychology. They bought high during euphoria and sold low during panic. And here is the most painful truth of all. They didn't sell because they were stupid. They sold because their brain was trying to protect them from pain. So how do social pressure, market mania, and constantly checking your phone make this neurological glitch 10 times worse? And more importantly, how do we fix it? If loss aversion was the biological spark, our modern digital world is the gasoline. In the 1980s or 1990s, if you owned stocks, you received a paper statement in your mailbox once a month. If the market crashed on a Tuesday, you probably didn't even notice until weeks later, by which time the recovery might have already started. Today, you carry a hyper-engineered casino in your front pocket 24 hours a day, 7 days a week. In behavioral economics, this triggers a phenomenon known as myopic loss aversion. First coined by Nobel laureate Richard Thaler and Shlomo Benartzi, myopic loss aversion combines two brutal psychological realities: extreme loss aversion and overly frequent evaluation. Here's the math your brain doesn't want you to know. On any given day, the stock market has roughly a 50% chance of being down. It's essentially a coin flip. But over a 10-year period, the historical probability of the market being up jumps to over 95%. When you check your portfolio 15 times a day, you are forcing your brain to experience loss aversion trauma over micro fluctuations that have zero impact on your long-term wealth. Every glance at a red digit releases a microdose of cortisol. Check it enough times in a week, and your nervous system breaks down. And then comes the deadly second catalyst: herd mentality and social proof. Humans are social animals. When we see our group running away, our brain assumes there's a predator coming. During a market sell-off, social media platforms turn into echo chambers of pure panic. Headlines switch from calculated analysis to sensational apocalyptic doom. Look at what unfolded during the retail trading frenzy of 2021 and its catastrophic aftermath. Driven by FOMO, fear of missing out, millions of new retail investors bought into speculative hypergrowth tech stocks and meme assets at their absolute historic peaks. Online communities posted screenshots of massive green portfolios, feeding the illusion that prices would rise forever. When the macro environment shifted and those stocks began to crater 40%, 60%, even 80%, the psychological trap closed tight. In Phase 1, investors held on due to the disposition effect, refusing to admit a mistake. But as months went on and headlines grew more negative, the chronic stress became unbearable. By early 2022, social media wasn't posting rocket emojis anymore. It was screaming about systemic collapse. Individual investors surrendered at the bottom, selling off high-conviction assets at 70% discounts just to stop the emotional torture. They didn't sell because the businesses suddenly ceased to exist. They sold because their environment was optimized to induce panic. Their phones were pinging, their social feeds were screaming, and their brain gave out. So the question is, how do we build a fortress around our minds so we never fall into this trap again? You cannot eliminate human emotion. Your amygdala has had a 200,000-year head start. But what you can do is build behavioral systems that make emotional decision-making mathematically impossible. Here are 4 battle-tested strategies to rewire your investment psychology. Hack number 1, low-frequency auditing. Remember myopic loss aversion. The cure is simple. Stop staring at the coin flip. Delete your stock tracking apps from your phone's home screen. If you are a long-term investor with a multi-year horizon, checking your balance daily adds zero value and massive psychological friction. Schedule a quarterly or biannual portfolio check. By reducing how often you look, you drastically increase the statistical likelihood that what you see is green, protecting your brain from loss-induced stress. Hack number 2. The Ulysses Contract. In Greek mythology, Ulysses knew he couldn't resist the seductive song of the sirens, so he had his crew tie him to the ship's mast before sailing past them. In investing, you need to tie yourself to the mast. Set up automated dollar-cost averaging. Configure your bank account to automatically buy broad market index funds or your target assets on the first of every month, regardless of market conditions. When buying is automated, you remove the rationalizing brain entirely. You buy when it's high, you buy when it's low, and you completely bypass emotional hesitation. Hack number 3. The Pre-Mortem SOP. Never make a financial decision when your amygdala is burning with adrenaline. Write down a standard operating procedure document when the market is calm and rational. Specify exact conditions. If my portfolio drops 20%, I will not sell. Instead, I will execute check 1. Has the long-term fundamentals of the broad market changed? Check 2. Am I using money I need for rent next month? If no, I do nothing or deploy allocated cash. When panic strikes, you don't think. You simply execute your pre-written rules. Hack number 4. The Inverted Mindset. Imagine walking into your favorite retail store and seeing that every single item is suddenly marked 40% off. You don't scream in terror and run out of the building. You grab a shopping cart. Yet, the stock market is the only market in the world where consumers run out of the store when everything goes on sale. Frame market corrections for what they actually are. Historic buying opportunities for productive assets at a discount. Wealth in the financial markets isn't created by predicting the future. It's created by enduring the present. The stock market is a machine designed to transfer money from the impatient emotional investor to the patient, disciplined one. When the sea of red inevitably returns, and it will, remember that your fear isn't a signal to sell. It's simply an evolutionary relic firing off in a modern world. Acknowledge the panic, step away from the screens, stick to your plan, and let time do the heavy lifting. If this video helped you understand the psychological wiring behind your money, hit that like button, subscribe to Money Mindshift, and drop a comment below sharing a time you fell into the loss aversion trap and how you plan to fix it next time. Until next time, stay disciplined, master your mindset, and keep building.